Hello, ladies and gentlemen, and welcome back to our Shore Financial Property and Finance podcast. Today we have a very special guest. We have the founder of InvestorKit, Arjun Paliwal.
That's me, my friend.
Welcome.
Thank you.
Arjun has, I should say, the InvestorKit has won Best Buyers Agency of the Year for the last 2 years in a row at the Real Estate Business Awards, the national awards that is. Arjun's an ex-banker turned real estate sort of property expert, you could say. They've transacted over 1,000 properties since establishment in 2018, operating in all marketplaces of Australia, over $1 billion worth of properties purchased on behalf of customers. So Arjun, welcome aboard.
Thank you, mate. Appreciate the intro.
So lots going on. You know, we won't recap too much on the finance update we gave in the last podcast. But in a nutshell, you know, we had the interest rate forecast go from rates coming down last year to rates going back up. And now it looks like rates coming back down this year. So confidence is back in the marketplace. Supply levels are up, but it's being met with increased demand as well. So clearance rates are strong, well, across New South Wales at least. You know, what are you seeing across the whole of Australia at the moment?
Yeah, firstly, you've touched on a couple of key points, and I think the most fascinating thing to point out is the level of recovery and growth that's happening whilst interest rates technically have not fallen down heavily, right? And this is the big thing that everyone was worrying about in 2024, going, hey, the rates are pretty high now. They're not come off just yet. Are we going to feel something? And it's clear that we're not feeling what everyone thought was going to be the issue. And I'm not saying that households aren't having some sort of pain or pressure. That's definitely clear. But in terms of the actual production of that onto the market, that's not clear in terms of listings surging to such levels all across the country, which is quite undersupplied at the stage. The big things to point out is Sydney and Melbourne had a huge recovery. Melbourne less so, but Sydney had a huge recovery. And that recovery pretty much caught up all its losses. And so the main thing to say is that we can't put those losses down to interest rates. We can put those losses down to the sentiment shift off the back of perceived impact of interest rates. And that's a big part that everyone makes a big mistake on, is they think something will impact them. And that think of something may impact decisions more than the actual something. And that's what we saw.
That's a fantastic point, and I've got some data to support that. It's actually a great shout out that you've highlighted that sentiment and beliefs actually have a bigger impact in the property prices rather than actual finances at the moment. So for those of you that are watching this podcast online and can see our screen, if we share this current slide where you can see dwelling values across Australia, ironically, where that sort of decrease in property prices or dwelling prices across Australia actually occurred was in 2022 when the expectation of rate rises was announced to come. And that's when sentiment changed and people thought, well, prices are going to come off because rates are going to increase aggressively. But actually in 2022, rates were still really low. They were only incrementally increasing. But that's where we saw a bit of a dip. Depends what area of Australia we're in, but between 5 to 10%. But ironically, last year in 2023, when rates were really high and borrowing capacities were crippled to about half, 47% decrease in borrowing capacities as of November last year, we saw actually prices across the country increase in every major city. So that's once again sentiment, because last year people could see that rates were peaking and probably soon to come off in early 2024. They were confident to make a decision and transact in that market.
Well, investor finance is showing it too. I mean, ABS tracks finance data and investor finance is rocketing back up. And if you think of the state of play and you go, well, Arjun, interest rates haven't come back down, why are investors taking up way more finance? It's the belief that it will. And that sentiment in its play again.
And to your point on hardships, once again, people watching this online can see this data we're sharing right now, which shows the infamous mortgage cliff. We're through the thick of it now. You can see the bulk of those 2% fixed rates rolling off to 6%, which was heavily sort of, you could say, publicised in the media. That was between July last year to December. We aren't seeing a massive increase in arrears, to your point, although Eliza Owen, one of the chief economists of CoreLogic, did give an important point in our podcast in the past that arrears do have a 6 month lag on actual, like the data we're seeing today is from 6 months ago, basically. So stay tuned to watch arrears maybe in 6 months, because I have heard from some of the banks like Pepper that they specialise in refinancing clients in arrears or in hardships as such, and they've seen an increase in refinance levels for that category. But that's one bank that specialises in it, so naturally they would see the most of that. So let's talk about the year ahead. That's enough about the year that was. Even despite, elevated interest rates and decreasing borrowing capacities, all the major bank economists are still forecasting growth this year. What are you seeing as hot markets of interest? There's the big topic that everyone is talking about is houses have run very aggressively for the last 3 years. Units have not, and that disparity now is not justified. Is units the investment class that people should be focusing on?
Yeah, it's an absolute hot topic right now. And it makes sense to be a hot topic because you see the pre-COVID or just at COVID average, the gap was about 17% as per CoreLogic. That gap is close to 45% now. So when you've got a circa 30% gap, naturally the investor's eye or even the home buyer that's thinking, well, why would I pay that? I just feel like this is a lot more affordable to be in the same dirt of land. I think that's naturally playing on people's minds. But it's important to recognize that we don't get lost with just short-term trends. We focus on the long-term trends. And if we take long-term 20 and 30-year data across units and houses have substantially outperformed. So firstly, there's meant to be a gap, and there always will be one. Now, will that gap sustain at 45% large? No, it won't. I do expect unit prices to pick up and catch up. But as an investor and an owner-occupier, you've got two different mindsets. An owner-occupier, you're not just driven by the land itself or the appreciation. You're driven by the location, the amenities, and so forth. And if we look at data that CoreLogic recently received, which was around the biggest premiums of suburbs, where the gap of unit and house prices the largest, Sydney was having a lot of those suburbs. And it was mainly in the east and the north and the most premium areas of Sydney, where you could have gaps of 2 to 5 mil on houses where the unit prices are in the ones.
And we're comparing the same size of dwelling, right? A two-bedroom apartment or a three-bedroom apartment versus a three-bedroom house?
Not exactly the same. It's more asset type, unit and house. So that unit disparity, majority of them are 1 and 2 beds. The configuration of units across Australia are more like that. But the configuration of houses are more 3 and 4s, right? So you're naturally going to get that gap. But the gap is biggest in Sydney. And so if you're an owner-occupier, you could look at this way. You could say, if I'm looking at the Vaucluse, the Mosmans, the North, the East, the Inner West, and I'm thinking out loud, I want to live in these great locations. Well, units are just screaming at you to say, if you want to live in the vicinity and you want to be in the area, the price multiple to houses is one of the largest it's ever been and the largest on record as well in current Sydney data. So it would make sense if you're planning to live there long term, it's not going to have investment forefront in your decision making. But as an investor, I would challenge it even if the gaps are large. Because if you make up that gap, say 30, 40%, it's a one-off event of you catching up to make up that gap. And once it's caught up, you're back to long-term averages that are worse growth than houses.
And also the important point to highlight with, comparing these asset classes, especially at maybe potentially different purchase prices, is your holding costs. Most of these houses have a lower yield than the units. So whilst one might outperform the other, you've got to look at your holding costs over that duration, let's say 10 years. And typically a house is probably around a 2.5-3% yield in Australia, in Sydney now, and a unit you can get 4, maybe even close to 4.5-5% in some markets. I've seen like in the eastern suburbs around sort of Coogee, Clovelly, those old Art Deco buildings. They're selling at very attractive yields.
Yeah, I think the key thing is look at them holistically in 2 ways. One is that the yields for houses are typically lower, but the second thing is also the types of units. You could have 2 units next to each other yielding 4%, but then one of them will have a fancy lift, a huge, lobby area with a reception area, maybe a swimming pool. I've even seen some with a little cigar lounge in them as well, mate. So they get pretty funny. And then you've got others that are, as you said, the Coogee, red brick, the originals, and they're pretty okay.
Personally, I like the basic old school Art Deco sort of traditional type of unit block, just for the strata fees to be lower, right? The fancy buildings. You sometimes, if it correlates to higher rent, you can justify it. But normally the higher strata fees, they outweigh maybe the extra $100 you might be getting a week.
They do. They totally do. We've done that analysis multiple times over, and you just won't see the wins that you're hoping for thanks to a fancy lift, a reception area, or a swimming pool.
Or a pool that no one really uses because it's a bit gross and weird.
Yeah, I'm with you.
Yeah. So Another thing I want to, since we've got the InvestorKit sort of founder and pro here, and the hot topic of this podcast today is investing as a whole, I want to sort of highlight and compare asset classes. Typically, for people that have funds in super would be the most appropriate comparison that we're making this for. Most people have, their funds in super invested in a sort of ASX 200 managed fund. What we want to do today, we've got a bit of data right here, which once again, if you're watching this online, we'll share this comparison of asset classes. Most people, if they have their money in that ASX 200 type fund, for the last 10 years, the ASX, all up growth inclusive of dividends or distribution sort of returns and yields, all up, you would have achieved 7.94% for the last 10 years. That's the average return plus dividends for 10 years, just under 8%. Now, if we compare that to, let's say, Sydney houses, as you can see there, it's 7%. If we look at Melbourne houses, 6%, Brisbane houses, 6%. So it's between 6 to 7% for houses, let's say. Units have been a little bit less, but then, like I said, you're picking it up on the yield. Now, you might think, well, that makes the ASX 200 look like a better investment class. That's incorrect, because if you're investing in the ASX 200, and let's say in our example here that we're going to move on to, you probably have, let's say, $250,000 as an example, invested entirely in the ASX with no leverage. It's just the 250 grand invested in the share market. If you were to buy a property with 250 grand, naturally you will leverage that investment. And we've provided two scenarios here, one being a negatively geared scenario for the Sydney house, and one being a positively geared scenario. So if you spoke to your accountant, they would discuss with you what is most suitable to you. If you're a high income earner, and when I say high income earner, earning probably over $120,000 a year, which is above the average, you would want a negatively geared investment, in my opinion. If you're below that, you'd be wanting a positively geared investment, giving you a sort of additional income and not sort of taking any cash flow away from your day-to-day sort of life expenditure. So if we look at that 250 grand in a negatively geared scenario on $1 million purchase, borrowing 80% being 800, we've used some assumptions online from BMT, the depreciation specialist, on averages for depreciation. We won't go through line by line, but for people watching this, it's right there in front of you online. You can see the negatively geared scenario only costs you $8,000 to $9,000 a year at an 80% LVR. That's using historical averages also on rental yields. Now, for Sydney, that was only 3% rental yield. So if you get more than 3%, it probably won't be so negatively geared. If you look at the Brisbane unit, we've used the 250 for a lower purchase price so that you have a lower LVR to achieve that positively geared scenario. So only a 70% LVR, a $750,000 purchase, and that is paying you $27,000 to $28,000 a year in that scenario with the same 250. Now, the difference between that ASX 200, you can see paying 7.94%, and these investments, the positively geared scenario is giving you $1.18 million in accrued equity. So that's after the debt that still would be on the property in 10 years' time. And the positively geared scenario is $996,000 in accrued equity after the debt. Now, you're not going to achieve that with an ASX 200 fund earning 7% on the entire amount. You can see here we've actually showed what that 10 years looks like. On that ASX 200, it would be $497,000. So you would have doubled your money if that $250,000 was sitting in the ASX, or you would have more than quadrupled your money, almost 5 times on a Sydney house, or 4 times quadrupled on a Brisbane unit. What's your thoughts to all that? Are you a believer of the power of leverage and using any assets that you have, or any cash, I should say, that you have invested in the most sort of strategic way?
Yeah, so you've touched on a really good point. The first part is leverage. When it comes to leverage, far too often people just look at the downside, which is the fear of repayments, cash flow, and things like that. But one thing that happens with leverage is that you're getting those deductions back, especially in a high interest rate environment like that. You're not going $1 down every time. probably getting 30 cents back almost or more on that dollar back. And then from there, you're also having the aspects of depreciation, which don't come into a give back scenario until exit or sale, right? We only give back portions of it, which means as you're holding the property, your cash flows are getting better because of these benefits of the gearing, but also the benefits of depreciation. The main thing, though, is that's the leverage piece, right? Like the leverage piece is far too often people are comparing apples and oranges because they're looking at a house as a whole as if everyone pays cash. That's not a high amount of people today who are buying, who are putting cash on every deal.
Well, no one would really buy an investment property with cash, right? Because it just you would rather diversify your wealth and put, even if it's just only 50% LVR and 50% gearing, you'd put the other half just even in the ASX or something that's liquid for you to access.
Absolutely. And so if your time horizon is sort of that 20-year and beyond, it's clear that the leverage scenario just wins almost every single time. But as your time horizon gets smaller, 5 to 10 years, the key thing that many people can make the mistake of is like not having that consideration of buying costs, selling costs, gains, and things like that, maintenance, repairs. So I do feel that with super being such a long-term play, many property investors should consider that a little bit more as an option because they get to unlock leverage. And also when it comes to super, many of the things that people don't realize is that Australia is broad in terms of its depth of purchase prices. Some of the fastest growing markets across the country in recent years were those between 400K and 600K. So just when you think, do I have enough? Is my balance large enough? Well, 400 to 600K is not what you need in super. 400 to 600K is the asset prices of houses across the nation. And so if you take 20% plus costs, plus a bit of money for diversification to meet those rules, suddenly you don't need those 200, 300, 400K fund balances.
No, exactly
right.
right.
People come back down.
Let's highlight that, right? So I use 250 grand as an example just because that we're seeing that's in our marketplace one of the most common amounts people are using and playing with to invest. But you don't need $250,000 to purchase a property in your super or a property in general. In your super, for example, you can actually probably get away with around $150,000 to purchase, and that could be $150,000 combined between you and your partner. So it could be just $75,000 each that you have. Could also be a sibling or a family member. But yeah, the power of leverage to highlight, that you can't compare that. Like I said, call it 8% on the ASX versus 7% on houses in Sydney as a comparison. If we go back to that data we had on the screen before, that 7% compounding for 10 years will just mean it's whatever price you're talking, 100 grand, 200 grand has just doubled in 10 years, where the 7% on the house with the power of leverage at 80%, you've doubled the bank's money. That's the key. You've turned, in that example we have on the screen, $1 million into 1.8, but you've only put that $250,000 in, so you've actually doubled money that's not even yours.
And the debt remains the same. The debt's today's debt, right?
Well,
the debt's coming down in P&I, right? So either or.
Well, actually, in that example that we provided earlier, the debt's actually been amortized down to 650 grand in 10 years. So that $800,000 loan's gone down to 650, and on that positively geared scenario, that debt's gone down to 427,000. So 30% LVR from 70% in 10 years. And you do need to think about a retirement plan for those now sort of being a bit more acute with their super. The good thing about these investments in your super and thinking about a retirement plan is that if you hang on to them until you're in sort of retirement phase, being 67 now, it's entirely capital gains tax free. It's entirely income tax free, the assets you purchase in your super. If you're in your 40s, then that's effectively 3 investment cycles, if you call an investment cycle 7 years. But in our situation, we're being a bit more conservative and saying sort of an investment cycle is 10 years. If we once again use the Sydney house price as an example of what it should look like in 20 years, using historical data, a $1 million investment property in 20 years should be worth $3.6 million. So that $2.6 million of profit is entirely tax-free if it was in your superannuation. And if you're renting it out on, call it 5% yield, you're getting, call it $180,000 a year, also tax-free, all from a $250,000 investment. What do you think about people needing to get a bit more active with their retirement planning and their superannuation? I think there's been a big push to self-employed contractors and more self-employed practitioners as a whole across Australia. There's data supporting that. And unfortunately, self-employed practitioners don't put money in their superannuation because they don't have to. And it's becoming a bit of a forgotten investment strategy, right?
Yeah, it's something that you will pay, like you'll pay the issues that come with it, because if you do let this go longer, the less time you have to catch up on that wealth that's lost.
It's for wealth creation.
Absolutely. And the second part is that many people don't realize with superannuation, it's very much independent in the finance end. Meaning you'll have your personal capacities, business capacities, but then superannuation is independent. And that allows you that if you feel, I'm not sure about my borrowing capacity, will I be able to make it work? With your team support, you'll be able to have a separate streamline of borrowing capacity because it's not tied to what your personal positions are necessarily holding.
That is an amazing shout once again. And I'm so glad you highlighted that point. So just to further explain that topic as such. Your borrowing capacity in your self-managed super fund is completely separate to your borrowing capacity in your personal names, meaning that it won't be reliant on your personal servicing. It can just be reliant on the rent and contributions. So even if you can't service or purchase a investment property in your personal name, you still may be able to pass servicing to buy in your super. And more importantly, the thing that we find that most consumers struggle with is that they buy an investment property in their personal name, but then in 3, 4, 5 years, they want to either purchase a home or upgrade their home. And unfortunately, the investment property, whilst it might be positively geared, is crippling their borrowing capacity. This won't happen if you purchase in your super fund, because it will the asset in your super fund and the leverage on that asset in your super fund will never hinder your ability to upgrade your home or purchase a home as such. So that's a really great shout, because like I said, we see people transacting all the time. The transaction costs, of 4.5 thereabouts in stamp duty plus 2% in selling fees. If you're buying investments that you're having to trade every 4 years or so, that is not a wise strategy at all.
It's not. And the final thing I wanted to touch on with super is that I've seen so many families look at that generational wealth piece that gets ticked off, because they might look at 3 kids and they go, personally, I've got my home, I've got an investment. Only 2 of the kids are sorted. Who's the unlucky one, right?
Yeah.
But then what happens is why many families believe in the power of property for generational wealth is that when superannuation or life insurances and clean cash go to any, sibling or any child, what ends up happening is that it usually doesn't last as long as assets do, hard assets, because people see hard assets, they don't always go to the trigger to sell it. And I think one thing that we've been seeing a lot of people in their super funds do is to go, I've got 3 kids, I do want to set up more of them, and I feel like if I can operate and get another asset under my belt, tangible, real estate, I want to be able to have that, so I have one for each child to set them up. And so that's something that's often missed, and this is another reason why this allows you to do that.
That is fantastic. It's a good shout. The other thing, I guess, on that comment of planning for the next generation and transacting investment properties, if we use those previous examples before, if we just look at them, I should say, $1 million property turning into 1.8 or 3.6 in 10, 20 years, sometimes you might think, well, I've got a lot of wealth tied in one asset, one property, and I do believe in the power of diversification and then maybe crystallizing those profits and splitting them into different asset classes. When I say different asset classes, commercial property, commercial syndication, or just different marketplaces across Sydney, especially if then you re-gear and have instead of having, let's say, a super fund that has one property worth $3 million, you could probably crystallize that profit, sell it, and go buy 2-3 properties worth $6 million. So you've got $6 million invested in the market and recognizing more growth. The good thing about doing that, once again, in your super, I'm very pro-super in this podcast today, but the good thing about doing that is super and crystallizing profits, it's not going to be as costly transactionally, I should say, because you're only going to pay 10% capital gains tax between now and retirement if you do recognize a profit, where in your personal name, you have to pay 24% if you're in that top income tax bracket. You naturally fall into that top income tax bracket probably the year that you do recognize that capital gain, because the gain itself is income and it pushes you into that tax bracket. So you can safely assume that it'll be around 24% capital gains tax. So 10% versus 24% in that wealth creation stage does make a big difference to those decisions as such. I think that's probably enough about the reasons to invest in super. What are some of the other key topics you felt like you want to hop on here today and talk about? You've been, like I said, covering the hot topic of units versus houses. What about the hot topic of other marketplaces like WA and Brisbane? Any tips or tricks out there for the investors you're working with that is of great value add to your service as such?
Yeah, absolutely. So we last year actually did a report on overvalued and undervalued markets. And it was a methodology where we had inspiration from the University of SA. And when we looked at the data points, it was essentially taking household income and using that household income and saying, hey, let's assume this household wants to spend 33% of their income towards mortgage payments. Anything more than that is a bit too much. Anything less than that, they got space. Then what we're going to do is we're going to take the typical home price in an area and assume we're taking a 30-year P&I loan, principal and interest, with interest rates at 5.5 and 6.5%. So different settings just to test it out. We then wanted to make sure it was a 20% deposit. So we've got some real typical scenarios here, right? And when we did that, we were able to then map out if an area was overvalued and the price of the house needed to drop by X% to meet all these metrics, like the 30% mark or 33% mark. Or if a location was undervalued and the house metrics of prices needed to rise so that it could be at fair value again. And so this allows us to see which markets are undervalued and overvalued by mortgage repayments, because I truly believe that the house price to income ratio is broken. It doesn't require a review, because I think that it's separated so far because mortgages, different styles of interest rates have come in since the days of the past where interest rates were very different. So you can't use that metric to say, oh, everything's unaffordable, because if everything was unaffordable, how did people buy? Like, do you know what I mean? Like, people are buying, people are transacting 500,000 to 700,000 times a year. So with the strenuous bank, ways to look at people's affordability, we're setting some pretty good standards here, which means people are getting loans.
Well, let's actually once again highlight exactly what you're referring to on that income to house price ratio. In the last 20 to 30 years, it's gone from 2 to 3 times your annual salary is what you'd normally pay for an average house price, and now it's about 8. Is that right?
Yeah, it's gone up pretty high, right? And so the main thing is we want to now separate that as a metric and look at repayments, because at the end of the day, we can look at these thresholds, but these thresholds are warped now on house price to income, because we're getting money and access to credit is easier now than it was in the past in terms of the frequency of dollars we're getting as a multiple of our salaries, right? And so today, when we look at this metric and we charted out last year's report release of this data, and we essentially saw, well, what were the most undervalued markets this time last year when we released the chart? And we're now releasing this report at the end of this month in March. So when this month report comes out, it'll actually show that the most undervalued markets of last year were the ones that started picking up a lot this year. And they were Perth, parts of Adelaide, Townsville, Toowoomba. These smaller locations, both from a regional and capital city centres, actually in the last 12 months and likely for the rest of this year, are going to perform better than some of our major cities, simply because they are much better on the affordability spectrum. But this is now the next part, transitioning to interest rates lowering. If interest rates continue to lower, the pendulum's going to swing at some point, because those who could not borrow but wanted to borrow start joining the race.
So apart from the obvious affordability benefit for these regional areas being attractive to homeowners and even investors, the other behavioural change that sounds like it's here to stay is people are moving to these regional areas because of working from home arrangements, which aren't really going away anytime soon, right? Yeah,
that's a big piece. So firstly, is it at peak levels of when COVID first hit? No, it's dropped off a little bit. But is it higher than the averages? Yes. And was it always trending up? Yes. So whether COVID happened or did not happen, it still would have been in this direction because it's been trending up. In fact, there's some cities which have been losing people for like decades. And they're major cities that get a lot of overseas population, like Sydney and Melbourne. They lose more people internally, but then they get a lot of people externally. And so the key to think about is, yes, that trend has picked up. But the two big X factors on growth that's happening in some of these affordable cities I've named is actually local economic strength and local supply conditions. One big dynamic that's changed in Australia over the last 5 years has been the spread of economic prosperity. far too long have all the economic prosperity has been our biggest cities, the biggest buildings, and so forth. But then what started to happen over the last 5 and even going out to 10 years is when we measure data points like infrastructure per capita, when we measure data points like unemployment, job advertisement percentage changes, GRP and GDP at the national and then coming down to local levels, it's clear that there is no singular Sydney-Melbourne economy anymore. It is really spreading far and wide, obviously to relative population sizes, because you can't look at it from, a 30,000 city and say that that's now a powerhouse of Australia. Relative to its size, though, it's punching well above its weight, right? And so I think that dynamic's shifting. The second is supply. We're seeing, for example, Adelaide. Adelaide has supply levels at 35% below this time 5 years ago. So when you're talking 35% below houses for sale, a slow construction pipeline nationally, vacancy rates below 1%, and fairly affordable prices, how can prices not grow?
Yeah.
Now, that's the recipe that's happening across many parts of Australia.
There's always going to be upward pressure on prices with those conditions. And we did also highlight this in the last podcast, but just to touch on, we've got a 10-year low now of supply of new housing, but we have much more, a much greater population than we did 10 years ago, and record amounts of population growth with migration levels. So in every marketplace, there's going to be some form of upward pressure on prices, regardless of population in those specific marketplaces as such, because you're always going to get, when I say population, I mean migration levels, because you're always going to get, to your point, people may be migrating to Sydney, but then people in Sydney are migrating to regional areas.
Yeah, and I think what you've touched on there in terms of a couple of numbers you mentioned, population, supply, I always like to go, can I simplify this down to a barbecue statement? And if I can go, there are more people coming in, there are more wages increasing, there are less houses for sale, less houses for rent, and less houses being built. If you just ignore everything else, let's not pretend at all like we're scientists or economists or anything, and just go these 5 things at a barbecue, tell me which uncle is going to be wrong at the barbecue with these 5 metrics of a place to grow in house prices.
I feel like the typical barbecue conversation has really come a long way over the last 10 years. People have really become a lot more acute to property and finance as such, and a lot more educated with what's going on. On that note of economic data and what's going on out there, people were talking about 2024 potentially having being a year of a recession, and there was speculation of the soft landing as such is what everybody referred to in the US. We just finished reporting season for the ASX 200 companies, and that's a good indicator of the performance of the economy, the shape of the economy as such. And most businesses reported great earnings. That's why our share market is back at all-time highs the last 2-3 weeks. Same in the US, all-time highs for most of those indexes as such. So that does indicate that we're probably through the thick of the tough times. The paying the increases of interest rates have caused in terms of overall the overall economy. Businesses are still making money, people are still spending money, and I think the forecast for the year ahead is somewhat promising as such, opportunistic, right?
Yeah, there's some interesting parts in that data. So there's 2 ways to look at it. Have we come out way better than what we should have been with this manufactured slowdown? Manufactured being interest rates are trying to pump the economy down because it went too hot for too long. The answer is yes, we're performing way better than where they assumed we would be based on how much negative force is being placed on the economy with interest rates. But the answer to whether the year's better from an economic perspective has kind of 2 halves to it, right? I'm of the firm belief that last year we overshot interest rates. They're too high in comparison to where they should be. Now, they're not showing cracks in terms of household balance sheets or people feeling like they need to sell everywhere. Otherwise, listings data would show that, and it's not showing that. But from an economic perspective, inflation data and economic activity data is changing directions faster than ever. Like the same speed it went back up for inflation, the speed is now on the way down. And so when that's happening, you've got 2 decisions as policymakers. Just keep that there for a little bit longer, but then you have to move back down on interest rates just as quick, or you probably start to move it down a little bit sooner, and you start to find what we call a soft landing.
It's funny. That's a very controversial topic there because, Michelle Bullock, the new RBA governor, has actually, most recently come out in her last meeting saying that she's not ruling out another increase in interest rates.
Yeah.
And whilst you think we might have overshot the mark there on rate rises, we're still about 1% below the US Fed sort of cash rate. And that disparity of, call it 1% between us and the US is a direct correlation to why our Australian dollar has crashed so aggressively. Correct. Because investment banks, the bonds markets across the world they're selling off Australian bonds and buying US bonds. And when you're selling off billions of dollars of bonds because we're paying 1% less than places like America, and the UK is not far off, then that's going to obviously make our dollar crash. So there was a bit of a balance there for the government where whilst interest rates at 6% here are probably going to have a bigger impact of the economy compared to interest rates of, let's say, 7% in America because they're 1% higher. In America, they're going to have a less impact because people take fixed mortgages and the increases in rate isn't affecting the housing market as such, but it's more associated with businesses and whatnot. They still then have to take into these external global factors of maintaining an attractive dollar because of imports and exports. If our dollar crashes, then imports become more expensive, and that's an inflationary problem. And our exports are less profitable. So
absolutely,
real balancing act for the federal government at the moment. I think given the circumstances, given a pandemic which was unprecedented, in modern day times, we got through it okay. And there is light at the end of the tunnel. We can see now that rates will come down soon. Half the major bank economists are forecasting sort of May, June. The other half are saying towards the end of the year. The hot topic for them to focus on is that ongoing inflation. And to your point, whilst it is steadily decreasing and heading down, there has been a bit of a bouncing point where it bounced back up and down around this current level of 4%, call it. And that's because there is a bit of a lag on inflation. Things like companies like Boral came out and made an announcement only a few weeks ago that they're increasing a lot of their building material, or the cost of building materials by 10 to 15%. They're a major supplier in building materials for the whole of Australia. So that's going to have a subsequent effect on inflation. Still some, price growth to come on regular products and services. So it's about where does inflation go from here, which will dictate what happens the next year or two in terms of rates. So that's a topic to stay tuned, really. And one important sort of shout out once again, transacting in a market like right now where nationally, borrowing capacities for the average punter, the everyday consumer, borrowing capacities have effectively halved since that last rate rise in November. 47% decrease. So if you're out there going through open homes, whether you're a buyer for a home or a buyer for an investment property, the competition around you, who you're bidding against, has a much lower borrowing capacity than they did a year or two ago, and a much lower borrowing capacity than they will in a year or two's time. That's why I am a strong believer in the fact that as soon as rates start coming down, prices are going to be very strong again. They're going to have that upward pressure where the price guide compared to the sold price is going to be a big disparity again, just like it was about 2 years ago.
Yeah, you're catching out like the core trend that's like about to happen, right? And so I think investors are already responding to it. Investor finance is a good lead indicator, and there's usually a 6-month lag from finance data with ABS to national price data. And so when we're seeing investor finance rocket away back up, even amongst these challenges of like borrowing capacity declines, it's clear sentiment's recovering because they want to make decisions. They envision something different. But the second thing is this whole period of like lending and COVID and interest rates, the biggest learning I've had in recent times with interest rates has been the difference between credit supply and credit demand. And I've gone on to talk about this a couple of times, but it's really important everyone understand the difference. Credit supply, as you pointed out, has reduced by 38 to 47%, depending on the banks you go to. So when you're seeing that supply reduce, that's one side of the equation. Demand is how much people want it. right? Having availability less doesn't necessarily mean the output by ABS data was also down 40%. It wasn't. And so what happened was we saw ABS data decline by close to 20 to 25% during the first phase of interest rate increases. But that's still lower than 30 to 40% in borrowing capacities, which means rather than the mind, this is very much a trick for the mind sees a chart goes down and it thinks 25% down, finance is getting hammered. But that's 10 to 20% higher than what borrowing capacities went down. So that means the net term is actually finance is better by 20% than availability of finance. And the big learning for that is that people shouldn't just use rules of availability of finance to dictate where they think the housing market will grow, because it's a combination of what's available and how much people want it. Whereas far too often we've gone by interest rate up, borrowing capacity down, therefore finance down, therefore prices down. That's all broken now. People should look at it from a perspective of interest rates up, finance, yes, availability down, but in all the other factors and conditions, do people want more of that finance or less? Well, hey, they want more of it. So, therefore, this does not equal that. And so that's the big learning for people who've analyzed the last 12 months of data and 18 months, is moving forward, we take all these learnings from COVID, we should take the learning of if the border's shut, it does not mean prices fall. Local supply conditions mean more, and also locals can create more households. You know, people, a family of 4 can create 2 families of 2. Then the next learning is if interest rates go up, prices do not fall. In fact, the last few interest rate events of going up, not just this time, but previous decades and cycles, they correspond because the economy's hot. And the economy is the first and most lead indicator of price growth.
And they're trying to slow down the economy just like they are now with inflation.
Absolutely. So it's actually a good thing because the economy's so hot, you should be happy. Hence why wage growth is phenomenal.
Yeah,
right?
record wage growth.
This is the key thing, is what you usually think is going to happen with housing, it's probably the opposite.
I love everything you're saying, and you're summarising it perfectly for our listeners. Before we wrap up, but you've been a fantastic guest on our podcast, and I can't wait to have you back in 6 to 12 months' time, and we can reflect on some of these topics and comments as such. Before we wrap up, I just want to encourage our State of Sydney report. We've been doing this for 2-3 years. We just released a recent State of Sydney report, which is the report that got us on sort of Channel 9 News and 2GB forecasting areas of interest and price growth in various suburbs of Australia. We break it up into 5 areas, or 5 quintiles, we call it, being based on average median prices. Hop on our website if you want to download the report, info@Shaw Financial. You can also just email and get a copy, but it's just been released only a couple of weeks ago. If you've got any more questions and you'd like to speak to one of our staff about getting set up to purchase a property, for example, in your SMSF, or you want to speak to InvestorKit, please feel free to reach out and we'll be happy to put you in touch. Thanks for coming on board today. Really appreciate your time.
Thank you, my friend. Appreciate it.